Welcome to a new episode of Economists Inside Mind.
Great to be back.
In our previous two deep dives, we really unpacked monetary policy transmission in Australia
hmm
and then looked at exactly how the Reserve Bank implements monetary policy.
That's right, laying the groundwork.
Exactly. So now, with that foundation, we're diving into something that, well, it really became a big deal after the global financial crisis and then again with the pandemic. Unconventional monetary policy.
Absolutely. For, decades, central banks pretty much relied on one main tool, the
Yeah.
policy interest
The
rate.
cash rate for us.
Right. But when those rates got pushed right down close to zero, like after the GFC between 2007 and 2009, and then, more recently,
Yeah.
they had to, get creative, find other ways to stimulate the economy.
So that's the mission for this deep dive then, to figure out what this unconventional stuff actually is.
Precisely. What is it? What are the tools involved? And importantly, how did Australia actually use them?
Okay, so maybe let's just quickly recap conventional policy first. For ages, it was all about changing that policy rate, the cash rate here.
Yep, the standard operating procedure.
And the idea, as we've talked about, is that tweak influences borrowing costs for everyone, basically businesses, households,
How much you get for saving, the exchange rate.
asset prices, houses, shares, all that stuff.
Right. You raise rates, you cool things down, lower inflation.
Cap the brakes.
Lower rates, you stimulate growth, push inflation up.
Hit the accelerator. Makes sense.
It's the classic playbook. But what happens when that accelerator is already flat to the floor and the economy is still sluggish?
Or the brakes are off, but you're still skidding, maybe.
Yeah, good analogy. That's where unconventional monetary policy steps in.
Oh.
It's using tools other than just fiddling with that policy interest rate.
Okay, so what are these other tools? What's in the unconventional toolkit?
Well, the main ones we've seen emerge are things like forward guidance, asset purchases, you've probably heard that, called QE, or quantitative easing.
Right, QE gets mentioned a lot.
Then there are term funding facilities, some adjustments to how central banks operate in markets day to day, and even the slightly weird one, negative interest rates.
Okay, let's take those one by one. Forward guidance. That just sounds like the central bank telling us what it's planning to do. Is it really a policy tool?
It is, actually, and quite a powerful one. It's really about managing expectations very deliberately.
How so?
So the central bank communicates clearly about where it thinks the policy rate is heading in the future. They might say, we won't raise rates until a certain date. That's time-based.
Okay.
Or maybe more powerfully, we'll keep rates low until the economy hits certain markers, like inflation reaching the target or unemployment falling below some level. That's state-based.
Tying it to outcomes.
Exactly. And the power isn't just saying it. It's about making people believe it. If businesses and households expect rates to stay low for longer.
They might borrow or invest more now.
Precisely. It reinforces the commitment to low rates, helps bring down expectations of future rate hikes, and just generally reduces uncertainty, which is super helpful in a crisis like the GFC or COVID. It's like saying, look, we're serious about this. Here's the plan.
Got it. Adding predictability. Okay, next. Asset purchases. QE. This feels like where things get, well, maybe more controversial or misunderstood. What exactly is happening here?
Yeah, they're definitely myths. At its core, asset purchases mean the central bank buys assets, mostly government bonds, since the GFC, from the private sector, like banks.
Okay, buying bonds. But how do they pay? Is this the printing money people talk about?
Good question. No. They pay by creating central bank reserves. In Australia, we call them exchange settlement balances, or ES balances. It's like the RBA just credits the seller's bank account electronically.
So it's digital money creation, not physical banknotes rolling off a press.
Exactly. It's not about printing stacks of cash. Central banks have actually done small-scale asset stuff for ages, but post-GFC and during COVID, the scale just exploded. Central bank balance sheets got huge.
Right, so why buy all these government bonds? What's the goal?
The main aim is usually to push down the interest rates or yields on these very safe assets like government bonds across different time horizons, the whole yield curve.
How does buying them lower the yield?
It's supply and demand, basically.
Yeah.
When the central bank comes in as a massive buyer.
It then goes way up.
Right. And when demand for bonds goes up, their price gets pushed higher. Now, bonds have this inverse relationship between price and yield. Think of it like a seesaw.
Price up, yield down.
Exactly. So by buying bonds, the central bank forces their price up and deliberately pushes their yield down. This lowers borrowing costs, linked to those bond yields.
Okay, so it's another way to lower interest rates, especially maybe longer-term ones, that the main policy rate doesn't directly hit as much.
That's a key part of it. It reinforces that forward guidance about keeping rates low overall. And there's another effect called portfolio rebalancing or portfolio adjustment.
What's
Well, the institutions that sold the bonds to the central bank now have cash, these ES balances. They probably don't want to just sit on that cash earning very little.
right? They'll look for something else to invest in.
Exactly. They might buy other assets, maybe corporate bonds, maybe shares, things that offer a potentially higher return. This extra demand can push up the prices of those assets too, and maybe even influence the exchange rate.
Interesting. Okay, you mentioned government bonds and the yield curve. Maybe a quick explainer for anyone not living and breathing finance.
Sure thing. A government bond is basically just a loan to the government. You lend them money for a set period. They promise to pay you back with interest.
An IOU from the government?
Yep, when the government first sells them, that's the primary market.
Yeah.
But then investors trade them amongst themselves. That's the secondary market. And that's typically where the central bank does its buying for QE.
Okay, secondary market.
Right.
And the yield curve.
Imagine you plotted the interest rate, the yield you'd get on government bonds that mature at different times, say in 3 months, 1 year, 5 years, 10 years, 30 years. That line connecting those points, that's the yield curve.
And it's called risk-free.
Generally, yes, because a government borrowing in its own currency is seen as extremely unlikely to default. And this curve is super important because it acts as a benchmark for pricing almost all other debt in the economy. Mortgages, business loans, they're all influenced by it.
Got it. Very helpful. Okay, next tool. Term funding facilities. What are they about?
These are basically schemes where the central bank offers low-cost funding directly to banks and other financial institutions, but for a longer term, like maybe 3 years.
And usually cheaper than they could borrow elsewhere.
That's the idea. Often the rate is linked to the central bank's policy rate, making it very attractive. We saw these used after the GFC, and they were a big part of the COVID response too.
Why do this? If the main policy rate is already near zero,
It helps lower the funding costs for banks over that medium term, which should then, encourage them to pass on lower borrowing rates to their customers, businesses, and households. It helps keep credit flowing.
so it directly targets bank funding costs to try and influence lending rates.
Exactly. And sometimes they have added features, like incentives for banks to lend more to specific sectors, perhaps small businesses that might be finding it harder to get credit.
Right, a bit more targeted. Okay, then adjustments to market operations. Sounds quite technical. Tinkering under the hood.
That's a good way to put it. These are changes to the central bank's regular interactions with the financial system, the sort of day-to-day plumbing.
What kind of changes?
During big stress events like the GFC or the start of the pandemic, financial markets can get really gummed up. Banks get nervous about whether they'll have enough ready cash liquidity to meet their obligations.
So they might hoard cash and stop lending?
Exactly, a credit crunch.
Yeah.
So central banks step in to prevent that. They might offer much larger amounts of money in their usual lending operations.
Pump more liquidity in.
They might accept a wider range of assets as collateral when banks borrow from them,
Make it easier to borrow.
and maybe even let more types of institutions access their facilities. The goal is just to keep the financial system functioning smoothly, make sure banks aren't scared to lend to each other or to customers because they know the central bank is there as a backstop.
Makes sense. Keeping the pipes clear. All right, the last one. Negative interest rates. This still sounds counterintuitive. Paying the bank to hold your money.
It does challenge the old thinking. For a long time, economists thought zero was the absolute floor, the zero lower bound. Because why would you keep money in a bank if it cost you when you could just hold physical cash for free?
Right. The mattress option.
But some central banks, particularly in Europe and Japan, actually did push their main policy rates slightly below zero.
And did it work? Did people start getting charged?
Well, the idea was to really push commercial banks to lend money out rather than park it at the central bank. But in practice, most commercial banks were very reluctant to pass those negative rates on to ordinary household depositors or small businesses.
Why not?
Probably worried customers would just pull their money out as cash the mattress option again.
Yeah.
And, the potential political and public relations backlash.
So it didn't quite filter down.
Not really to everyday people. It suggests there's maybe an effective lower bound that's close to, or maybe slightly below zero, where things get tricky because people might just opt for banknotes.
Okay, fascinating toolkit. So let's bring this home to Australia. You said earlier we weathered the GFC okay with conventional tools.
Yeah, Australia was relatively resilient then.
Hmm.
The RBA cut the cash rate aggressively, made sure there was plenty of liquidity, but we didn't need to roll out QE or negative rates or anything like that back then.
But COVID was different.
Totally different beast. The economic shock was just massive, unprecedented in peacetime, really. So that's when the RBA, starting around March 2020, deployed unconventional policies for the first time here.
Right. A historic shift.
And they expanded them further in November 2020. The clear goals were supporting jobs, getting the economy back on its feet.
And these were used alongside the cash rate changes, not instead of...
Absolutely, they were complementary. So on the interest rate front, the cash rate target itself was cut to its lowest ever level, just 0.1%.
rock bottom.
And that tiny target meant they had to adjust how their corridor system worked. Remember how we discussed that?
Yeah, the band around the target rate where banks borrow or lend from the RBA overnight, normally 0.25% above and below.
That's right. But with the target at 0.1%, the rate the RBA paid banks on deposits in their ES accounts would have gone negative.
Oh, okay.
So to avoid that, they just set the rate paid on those ES balances to zero, flat zero. That effectively put a floor under all interest rates in the economy.
So zero became the effective floor.
And interestingly, because of all the money created through asset purchases and the funding facility, these ES balances swelled massively. There was so much cash sloshing around the system that the actual overnight cash rate traded in the market ended up hugging that zero floor much more closely than the official 1.1% target. You can see that in the chart we've got.
Right, the sheer volume of reserves pushed the market rate down to the deposit rate. Okay, what about asset purchases in Australia? What did the RBA buy?
They tackled it in two main ways, aiming to lower rates across the yield curve. For the shorter end, they use a price target.
A price target.
Yes, they specifically targeted the yield on the 3-year Australian government bond, aiming to keep it around 0.1%, same as the cash rate target.
And they'd buy however many bonds needed to hit that yield.
Exactly. They committed to buying whatever quantity was necessary. That 3-year rate is a really key benchmark in our financial markets, influencing lots of fixed-rate loans.
Okay. And for longer-term rates.
For longer maturities, say 5 to 10 years out, they used a quantity target. So they announced they would buy large volumes, specific amounts of Australian government bonds, and also bonds issued by the states and territories.
With the goal of pushing those longer yields down too.
Precisely. Lowering borrowing costs further out along the curve.
And forward guidance. We certainly heard a lot from the governor then.
Very much so. The guidance was quite explicit. The governor stated the cash rate wouldn't rise until actual inflation was sustainably back in the 2 to 3% target range.
Sustainably being the key word.
Absolutely. And they stressed this would require significant gains in employment and much stronger wages growth. It was very clearly state-based guidance.
Did they give any time frame?
They did provide some indication of when they thought those conditions might be met, adding a sort of time-based element alongside the economic conditions.
Okay. And did Australia use a term funding facility, the TFF?
Yes, we did. The RBA set up the TFF, offering banks and other deposit takers funding for 3 years at a very low fixed rate, initially 0.25%, then lowered to 0.1%.
3 years matching the yield target and forward guidance timeframe.
Deliberately aligned, yes. The main aim was, again, lower funding costs for banks to support the supply of credit.
Any special features?
Yes, there was an incentive built in. Banks could borrow additional funds if they increased their lending, particularly to businesses, and especially small and medium-sized ones.
Trying to encourage that specific lending. Got it. And those market operation adjustments, did we see that here too?
We did, especially right at the start of the pandemic when markets were seizing up. The RBA massively increased the size of its regular liquidity operation.
Nothing in cash.
They also widened the range of collateral they'd accept, making it easier for banks to access funds. And importantly, they also conducted separate purchases of government bonds. Commonwealth and state purely focused on making sure those crucial markets kept functioning smoothly. These were distinct from the QE purchases aimed at the yield curve.
Just keeping the market working.
Exactly. Addressing dysfunction.
Okay, so Australia really threw the kitchen sink at it, using a whole suite of these unconventional tools. Stepping back, what are the big picture goals and any potential downsides people worry about?
Well, the goals are ultimately the same as conventional policy, just using different means.
Yeah.
Lower interest rates further than you otherwise could, put downward pressure on the Aussie dollar, hopefully boost asset prices a bit, provide liquidity to stop markets seizing up.
Financial stability.
Right. And reducing uncertainty with that forward guidance.
But are there risks? Unintended
There are
consequences?
always debates and things to watch. One concern sometimes raised globally is whether providing too much easy central bank liquidity reduces the incentive for banks themselves to hold enough buffers.
Moral hazard.
Kind of. Though, as mentioned, we have pretty strong regulations in Australia designed to counter that. Another is the effect of very low rates for a very long time. Could it hurt bank profits?
Was that a big issue here?
Less so in Australia. Our banks remained quite profitable. There's also the zombie firm argument. Do low rates keep unproductive firms alive? Though during COVID, the focus was really on supporting viable firms through an unprecedented external shock.
Makes sense. What about asset bubbles? Or the line between monetary and fiscal policy?
Both common discussion points. On asset prices, yeah, it's a risk, but you have to weigh that against the alternative, which during COVID was potentially a catastrophic recession and mass unemployment.
A tough balancing act.
For sure. And on monetary versus fiscal policy, the idea that buying lots of government bonds is like the RBA funding the government. It's important to remember the RBA buys bonds in the secondary market, not directly from the government at auction.
So the government still has to issue the debt and find buyers initially?
Yes.
Yeah.
And the government absolutely still has to pay that debt back when it matures. It's not direct financing.
Okay. What about the idea that QE benefits the wealthy disproportionately?
That's another frequent point of debate. Asset purchases can push up asset prices, and wealthier people tend to own more assets. However, the counterargument is that the primary goal is supporting overall economic activity and jobs.
Which benefits everyone, ideally.
Right. A stronger economy and lower unemployment help broadly across society. The evidence on the ultimate distributional effects is complex and still being studied.
So looking back at the COVID period, it was the biggest peacetime contraction since the Great Depression here. This unconventional response was seen as pretty essential.
Absolutely necessary. Given the scale of the threat, the RBA was very clear. Its focus was jobs, recovery, and working alongside what the government was doing on the fiscal side.
An unprecedented response to an unprecedented shock.
Exactly. You couldn't just rely on the old playbook.
Okay, so let's try and pull this all together. Unconventional monetary policy really kicks in when the standard tool, the policy interest rate, hits its limits, usually near zero.
Right, you need other ways to influence the economy.
And the toolkit includes things like forward guidance, shaping expectations about future rates,
Asset purchases, or QE, directly influencing bond yields and market liquidity.
term funding facilities providing cheap, longer-term funds to banks,
Market operations adjustments, keeping the financial plumbing working smoothly.
and even, theoretically, or in some places actually, negative interest rates.
That's the main menu, yeah.
And Australia, having avoided these during the GFC, really embraced them during COVID. We saw a cash rate floor hit zero, major asset purchase programs targeting the yield curve.
Very clear state-based forward guidance.
That term funding facility rolled out.
And those crucial interventions to ensure markets didn't freeze up. A really comprehensive package.
Designed to lower borrowing costs, support credit, stabilize markets, and boost confidence during a massive crisis.
That was the aim. And like all major policy shifts, it comes with impacts, benefits, but also ongoing questions and considerations to analyze.
Definitely food for thought. Which brings us to our final provocative question for you, our listener. Considering these experiences, first the GFC, and now especially the COVID pandemic, what long-term implications might this greater willingness to use unconventional monetary policy have for the future role and maybe even the future effectiveness of central banks around the world?